Let me. It is a crazy busy week for us.
Okay, Bismillah ar-Rahman ar-Rahim. Alhamdulillah Rabbil Alameen. Wassalatu wassalamu ala al-Nabi al-Amin wa ala alihi wa sahbihi ajma'een. Wattabi'ina lahum bi ihsanin ila yawmiddin amma ba'd. Our distinguished guest speaker, Dr. Mustafa Disli, respected online guest, my dear brothers and sisters. This is our pleasure to welcome you all to this weekly lecture on market discipline in Islamic banking. As a part of our activities and events organized by Islamic Economics Association of Kuwait University, today's lecture is very important for the researchers and students of the field of Islamic banking and finance. Our association is trying to promote the nature of Sharia compliant finance models, strategies, and also research models. We usually cover wide range of areas in Islamic banking, Islamic finance, microfinance, insurance, capital market, equity market, and also some other specific topics like fintech, sukuk, retail, and corporate banking products, and some more contemporary issues with SDGs, Sustainable Development Goals, and the relation of between the Maqasid al-Sharia and also the Sustainable Development Goals of UN. So today we are very much honored to have our guest speaker, Dr. Mustafa Disli. Dr. Mustafa is an assistant professor at the College of Islamic Studies, Hamad bin Khalifa University, Qatar. And he received a BA in economics and MA in economics, as well as a MA in banking and finance. He obtained PhD from Ghent University in Belgium. And Dr. Mustafa's research interests are in the areas of Islamic banking and finance, energy and sustainable economics, behavioral economics and finance. Dr. Disli has published across a number of peer-reviewed journals, including economic modeling, energy economics, renewable and sustainable energy reviews, Journal of Comparative Economics, Journal of Finance Services Research, Journal of Financial Stability and World Economy. So without further ado, let me invite Dr. Mustafa Disli to conduct today's lecture. So please welcome, Doctor.
Thank you very much for the very nice introduction, Dr. Muhammad. So I will share my slides. Okay. And let me do it a slide view first. How do I? Yes, is it clear?
Yes, Doctor.
Okay. So again, thank you very much, Dr. Muhammad, for the very nice introduction. Salam everyone, my name is Mustafa Disli. I'm a faculty at the Hamad bin Khalifa University, Qatar, as Dr. Muhammad also said. And the topic of my lecture is about market discipline and Islamic banking. Now, as you can see from this slide, as you can see from the pillars of the Basel guidelines, the regulator increasingly emphasized the role of market discipline to complement the oversight of the regulator itself. So Regulator sees market discipline as a device to complement the regulatory oversight of the regulator. That's why they are increasingly promoting this channel. And from a bank corporate governance perspective, and as you know, banks, they are dealing in people's funds, and normally they should act as trustees of the depositors. And from that perspective, from this normative perspective, the objective of a bank governance should be first the protection of the interest of depositors. And subsequently, they should think about the interest of their shareholders. Let me first introduce you with some concepts. So the first concept, which is actually also a little bit related to market discipline. So we have the concept of bank runs, and that is the phenomenon that people rush on the banks to withdraw their money. For this, in order to have bank runs, you need two ingredients. The first one is the fractional reserve banking, and the second one is the sequential service constraint. The fractional reserve banking means the following, that the banks, they hold only a small portion of deposits as cash and lend the major part of the deposits to borrowers. So they only hold a small portion aside from the deposits they receive. The sequential service constraint, on the other hand, says that depositors can only withdraw the deposits sequentially, meaning that whoever who comes first to the bank will be served first. And if you look at this equation, let me check whether I can use my cursor. Yes, I can do that. If you look at the equation, you do not need to have a bank in a bad condition to have bank runs. As you can see, fractional reserve banking, and the second ingredient is sequential service constraint. So this means what? That even rumors, unjustified rumors, can actually make a bank subject to a run. So let me also say something about the fractional reserve banking and how it is dealt within the Islamic banks. Here in this regard, the theoretical debate still continues and has not been settled yet, although in practice, Islamic banks, they continue to create credit as conventional banks. So there are actually two views in this regard. Let me first say what the first view is. Okay. So according to the first opinion, there is a separation of demand from investment deposits. So according to this view, the demand deposits are only for safekeeping purposes and therefore should have a 100% reserve requirement placed on them. So as you can see in this figure, they should be all set aside and cannot be lent out. What about the investment accounts or the investment deposits? So Mudaraba depositors are considered as quasi-shareholders. And for this segment, the bank does not need to hold reserves. So they can be invested into asset-backed and profit-sharing projects. That's one view. The second view is actually we can impose reserve requirements on both the savings as well as the investment accounts. Why? By imposing reserve requirements on the investments accounts as well, the Islamic banks, they can provide a withdrawal facility for the mudaraba or the investment accounts. And if this is allowed, then the central banks can also have more room to intervene in the economy's growth path. And again, according to this view, so the demand deposits cannot be set aside for 100%, check where my cursor is. Yes, here it is. So the demand deposits cannot be set aside for 100% because according to the Islam, it's not allowed, to hoard, to put aside, idle money. Again, that is two views. There are two views. In practice, it is the second view that is actually being implemented, sorry. So as said earlier, bank runs can happen even for banks that are not in a bad shape. So it is the rumors that can make a bank actually subject to a run. And why is that? Because the banks only hold a small portion of deposits as reserves. So if you don't run on the bank, then you might get out of this equation. You might lose your money. So it can be, as said, a self-fulfilling without, a justified fundamental issue. Another concept that I wanted to introduce is the deposit insurance mechanism. I will come back to this in one of the following slides. How is this implemented within the Islamic banking context? From a conventional view, there are benefits with deposit insurance, but there are also disadvantages with deposit insurance. So what is the benefit? The major benefit of a deposit insurance is that it actually blocks bank run. If you are certain that you will get your deposits, even if a bank fails, then why should you run on a bank? So you are not worried about your deposits. So it eliminates runs. However, what is the disadvantage of this? If deposits are guaranteed, then the depositors will not have any incentives to monitor the banks, to monitor the bank quality. And as such that banks are not punished for poorly behavior, so they might take on riskier loans. They might be engaged in more risky activities. Now, what is now market discipline? Market discipline is the process where the depositors reward or punish the banks in function of their riskiness. In order to have market discipline, first, the depositor should be able to monitor the bank, and that is usually done, or it is hypothesized that this can only be happening with increased transparency of the bank. And secondly, whether the depositors can exert influence on the banks. So from this context, if a bank is risky, so the bank is risky, then either as a depositor, you ask a higher rate or you will withdraw your money, right? So you will either increase your compensation, you will request a higher compensation, and you will, or you will withdraw your money. Because the bank is risky, why would you be satisfied with the same rate if the bank has become more risky? Or if you have, if the bank has become more risky, what will you do? You will otherwise just withdraw your funds. So let me put this in a deposit demand and the deposit supply graph. Okay, there's my cursor, it's here, yes. So you have at the horizontal axis, the volume of deposits. At the vertical axis, let's for now consider conventional banks. In subsequent slides, I will apply this model to Islamic banks as well. So let us first consider let us first consider the conventional banks. So as you can see, we have two curves. The demand for deposits, this curve, the demand for deposits, and the supply of deposits as the second curve. The demand for deposits is originated by banks. And as you can see, it has a negative relationship with the interest rate. So when the interest rate goes up, the demand drops. Of course, so when the interest on deposits become high, banks are less willing to demand for deposits because they have to pay more on the deposits. From the depositors' perspective, then we need to look at the supply of deposits. Meaning, you as a depositor will be having more incentives to deposit money on the bank when the bank gives you more compensation. As you can see, there is a positive relationship between interest and supply of deposits. When the interest rate goes up, then people will supply more deposits, right? So, what is now market discipline? Look at this equation. This is an important equation. A higher rate and a lower deposit base with increased bank risk. So how is this actually shown in our model? As such, if the bank risk increases, we have a leftward shift of the supply curve. Don't forget, as said, it is from the perspective of the depositors. So we are focusing on the deposit supply because the deposit supply is originated by the depositors. And if there is a leftward shift of the deposit supply curve, what do we have then? We have then this situation. So the rate increases and there is a decline in the volume of deposits. So we will only observe market discipline if there is a leftward shift of the deposit supply curve. Okay, so this is for conventional banks. So the question now is how we can change this model as such that it also fits the Islamic banks. That's a question. If you want to answer, please do so. So this is the model for conventional banks. How can we fit this model to the Islamic banks? If someone wants to answer, please do so. What should we change as such that this model also fits the Islamic banking model? No one? Just try if you want. Okay, there is no input from the audience. Actually, it's quite straightforward because, as you know, Islamic banking model does not work with interest. So this should be somehow deleted, right? This should be somehow deleted. So, as you know, we can make this model fit to the Islamic banking model by replacing the interest with the profit ratio of Islamic depositors. So this is the share of the profits given to Islamic depositors. And here the R is the return on deposits. Look, the profit share given to Islamic depositors. If the Islamic depositor receives a higher share of the profits realized by the bank, then he will supply or she will supply more deposits. From the bank's perspective, the larger the share of the deposit profits is, the less the bank is inclined to demand for deposits, because deposits become more expensive for the bank. So it is quite easy to transform the conventional model into an Islamic model. So actually, the mechanism of market discipline with a leftward shift of the deposit supply curve also is valid for Islamic banking model. So it is, as I said earlier, it is all about whether the deposit supply curve shifts to the left. We can have other combinations. We can have, for instance, so this is the market discipline, as said earlier, but we can have other combinations. If there is, however, a rightward shift of the deposit supply curve, like this, obviously, and look at this, this is the key, if at bank risk, the deposit supply curve shifts to the left, obviously we don't have then any market discipline, because the equilibrium outcome out of that, this one, is not compatible with the prediction of market discipline. Because what did the market discipline theory predict? That the interest rate would increase and the deposit base would decrease. So if there is a rightward shift, then there is no market discipline. However, there can be also deposit demand shifts like this. So if there is an increased demand by the bank with bank risk, look at this, what then or equilibrium outcome would be an increased interest. This is actually compatible with the prediction of market discipline theory. However, this is not compatible with the prediction of market discipline theory, because the market discipline theory says that the deposit base would fall. And what about the other direction? If you have a leftward shift of the deposit demand curve, let me remind you, the deposit demand is originating from the bank, whereas the deposit supply is originating from the customer, from the depositor. If you have a leftward shift of the deposit demand curve, then our equilibrium outcome is this. And this would then be compatible with the market discipline prediction, but however, a downfall of the interest would not be compatible with the market discipline reaction, with the market discipline prediction, sorry. Let me also elaborate a little bit further on this deposit demand effect. So there can be increased demand, deposit demand, so deposit demand originating from the bank with bank risk. Why? So for instance, an increase in bank risk could be associated with an increase in the demand for deposits if risky banks are expanding more aggressively. So they are willing to pay a higher interest because they are using those funds for riskier activities. But now you could ask, why would a bank decrease its deposit demand? Again, this is also possible. An increase in bank risk could be associated with a decrease in the demand for deposits if a bank would respond to a regulatory discipline by shrinking their operations. So, for example, a bank may respond to regulatory pressure on their capital ratios by reducing their assets, and so if their assets are reduced, they should also reduce their liabilities. Let me give you one concrete example, and this example originates from the Basel framework. So this is from the Basel III framework. So there is a leverage ratio imposed by the Basel III framework. And this leverage ratio is actually giving us the ratio of the core capital, the tier 1 capital, which consists of the common equity and the reserves, divided by the total assets. This ratio, according to the leverage ratio, should be higher than 3%. So as you can see, the larger the bank is, the larger the punishment is, right? Because your denominator gets larger. So this ratio punishes larger banks, so it actually stimulates banks to take initiatives to reduce size. If they take initiatives to reduce size, what would this mean? It would mean that they also need to shrink their liabilities consisting of deposits. Okay. Now, let us now turn a little bit more into the Islamic side, onto the Islamic side of market discipline. Actually, for conventional banks, the process of market discipline is well documented. So there are many papers published actually in top journals. So they show that depositors on average are able to discipline banks when they become more risky. For Islamic banks, it is a bit for Islamic banks, it is actually not the case. So there is lots of narrative, but there is no empirical evidence, unfortunately. So what is the narrative telling us? Depositors in the Islamic banking model are considered as quasi-shareholders. As a quasi-shareholder, there should be actually more market discipline. I will come back to this relationship, why there should be more market discipline with being a quasi-shareholder. I will come back to that in one of the following slides. So there is really lots of narrative that Islamic banking should promote more market discipline, and this would in turn promote financial stability. However, there is not much empirical work done that proves that this is also the case. Okay. Now, if you look at this equation, you have the conventional deposits at one side here, and you have equity on the other side. And Islamic deposits are actually like a hybrid of conventional deposits and equity. What do I mean by this? I mean the following. Compared to conventional deposits, so if I compare Islamic deposits with conventional deposits, Islamic deposits do not give preset interest, but rather give a proportion of the profits, right? If I compare Islamic deposits with equity, Islamic depositors are not given the control rights that shareholders enjoy. So from a theoretical point of view, Islamic deposits are actually a weaker construct than conventional deposits and equity. Why is that the case? Because Islamic deposits are subject to, compared to the conventional deposits, so Islamic deposits are subject to an uncertain income stream, and compared to the equity, they do not have any control rights. It's a hybrid, but it does not, it is a hybrid having their weaker components. So if this is the case, if Islamic deposits are a more weaker construct compared to conventional deposits and equity, then we should normally expect that Islamic depositors should be more vigilant about the riskiness of the bank. If a depositor becomes more vigilant about the riskiness of the bank, this would mean there is an increased market discipline, meaning an increased stability, financial stability. So my first remark is actually this profit and loss sharing arrangement should promote market discipline because of the fact that Islamic deposits are compared to conventional and equity, conventional deposits and equity are a weaker construct. So it should make Islamic depositors actually much more vigilant. What about another issue? What about the influence of religious commitment on depositor sensitivity? So how does religious commitment influence the disciplining actions of the depositors? Here there are two views, two opposing views. Again, I am more speculating because there is no empirical work on this. The first view is that religious individuals, they show more risk-averse characteristics than non-religious individuals. So, for example, a paper in 1995 so this is conducted in US, and this is about the religiosity of people. They found a negative association at the individual level between people who were more religious and their attitudes towards risk. So more religious meant less risk-taking. If I would apply this idea to the market discipline concept within the Islamic banking, then so they are more risk-averse. So if we suppose that the Islamic deposits are more religious, so they should be more risk-averse. So meaning they should be more vigilant towards the risk-taking of their banks, meaning this would increase market discipline. But again, this is one view. The other view says that Islamic depositors may actually have a strong sense of loyalty towards their bank. So if you are loyal towards your bank, because of religious capture, for instance, you don't have any other banks to go. There is only one Islamic bank. So, and you are actually more loyal towards your bank, this would actually diminish the market discipline incentives of the depositors. What about the deposit insurance and market discipline? Again, we don't know much about this as well. So the literature is silent regarding the impact of deposit coverage on market discipline. And as you know, in practice, there are different modes of Islamic deposit insurance, and this makes actually interpretations or predictions even more difficult. So there are two forms of Islamic deposit insurance. The first form is that the Islamic deposits are covered through the conventional insurance system. The second form is actually the Islamic deposits are covered, are insured through a separate Islamic deposit insurance scheme. This one. So this would mean that there are two deposit insurance schemes, one covering the conventional deposits, and the second one, the Islamic one, Islamic deposit insurance, covering the Islamic deposits. One side note, how is this done in practice for Islamic deposit insurance? This is done through a takaful agreement. Takaful, let me tell you a little bit more about this, is derived from the Arabic word kafala, which means guaranteeing each other, coming up for each other, and is based on the concept of social solidarity, collaboration, and mutual indemnification of loss. It operates on the principle of ta'awun, again, brotherhood or mutual assistance. When something happens to your religious brother, you step in to help him, and tabaru, which is actually donation, gift, or contribution. How is this organized? Each participating member contributes resources to support the needed participants within the group. Within the context of Islamic banking and Islamic deposit insurance, this would mean that the banks would contribute resources to support another Islamic bank that actually, for instance, is in trouble. And from a normative perspective, takaful is never established with the sole intention of earning profits. So takaful is done through either the mudaraba takaful, which would mean that the profit sharing, so under the concept of mudaraba, which means profit sharing, the takaful participants, which are the banks here in this context, so the capital providers, provides the funds to the operator who manages the funds and generates profits through Sharia compliant investments. So the parties to the takaful transaction enter into a cooperative risk sharing and profit sharing agreements. So what happens with the profits? The takaful operator shares in the profits earned from the investments, but does not bear the burden of losses. So who is bearing the losses? The Rabbal Mal, the banks in this context. I made a figure out of this, but I'm happy to share my slides about this. And the other thing is the wakala takaful. In the wakala model, so this is a contract that provides that the takaful operator will manage the takaful fund on behalf of the participants. Who are the participants? The Islamic banks. And they will be compensated. So the takaful operator, so the insurance company, will be compensated by a fee called a wakala fee. The operator is appointed as an agent, and a fee is then paid for this agent's expertise. Again, I can provide these slides upon request. What about deposit insurance? Now, there is a hot debate about this because profit and loss sharing investment accounts. So in theory, it would mean the following, right? So you would share in the profits of the bank, but you would also bear the burden of a loss. However, if there is a deposit insurance, then bearing the burden of a loss seems not to be any more valid, because you will get your money anyway. However, in practice, they use the argument of maslaha, so it is still instituted because it is something that is good, beneficial for the public. Why is that? It is considered that, for instance, having an unstable financial system would make the things even more worse. So if a bank fails because of bank runs, for instance, this would actually trigger a domino reaction as such that other banks would fail. And this would then cause, like, an outright financial crisis. The question is, does deposit insurance contain the element of public interest? So again, from a theoretical perspective, it's not clear-cut, but in practice, there is Islamic deposit insurance. And of course, if there is Islamic deposit insurance, coming back to our figure, this would mean that the depositors would not have any incentives to discipline their bank. So the deposit supply curve would actually stand on its place, would not move to the left if the bank is more risky. Why would it be moving to the left? Because you will get your money anyway, independent of the riskiness of the bank. Another thing is the following. Coming back to this two forms of deposit insurance, what we found, but this was for Turkey, this might not be applicable to other contexts. What we found for Turkey was quite interesting, because what happened in Turkey was the following. Until 2005, there were two insurance schemes, one conventional insurance and one Islamic insurance, right? What we found for Turkey is that having an Islamic deposit insurance actually reduced the market discipline incentives of the depositors. What happened after 2005, the Islamic deposit insurance was taken over by the conventional insurance scheme. So the Islamic deposits became protected, have become protected by a conventional insurance scheme. And what was quite surprising is that, you know, when your money is covered, is protected through a conventional insurance scheme, so what will happen then? If a bank fails, you will get, as an Islamic depositor, you will get reimbursed by this conventional deposit insurance scheme. And that reimbursement of funds are not necessarily Sharia compliant, right? So what we found for Turkey, after the merger of this dual deposit insurance scheme into one conventional insurance scheme, we saw that the Islamic depositors started to increase their disciplining activities towards their bank. What do I mean by this? They became more sensitive towards bank risk, asking a higher return or withdrawing their deposits. So actually, this is less Sharia compliant. This is quite interesting what we found. Being Islamic deposits putting under the Islamic deposits putting under the conventional insurance scheme is not very much is not very much advised, right? However, we found that it had like an effect of an increased discipline action by the Islamic depositors. So this was a quite interesting finding. Another element, and this is my last slide, it is about the profit equalization reserves. As you know, the Islamic banks, they use profit equalization reserves to mitigate displaced commercial risk. What is a profit equalization reserve? So Islamic banks pool a portion of their profits into a reserve system as such that that their returns are smoothed out over the years, and they also follow the conventional rates. If that happens, the return shared to Islamic depositors would mean that that is actually disconnected with their riskness, right? Because if a bank takes more risk, the expected profits, I'm talking about expected profits, would be larger. However, the usage of this profit equalization reserves would mean that actually there is a disconnect between the returns asked by the depositors and the riskiness of the bank. And this would actually make the observation of market discipline a bit more challenging. Thank you all. That was my last slide. I don't know whether I am on time. I think I stopped more early, Dr. Mohammed. What do you say?
Yes, Doctor, thank you very much. Mashallah, it was very well explained and informative session. Alhamdulillah, I believe that all participants benefited from your lecture, Alhamdulillah. So before we conclude the session, we open the floor for questions and answer or any additional points anyone would like to add, would like to comment. We happily welcome. So either you may raise your hand or you may write in the question and answer box.
Please feel free to ask anything you want to ask, and let's have, build knowledge together.
Inshallah. So we are waiting for any comment, any questions from the audience. Anything related to the topic you may share with us, or you may ask our Dr. Mustafa is already here. And we already dropped our slides in the chat group, so you may download the slides from the chat group.
And the audience can always contact me, you know, if I don't know whether they are not willing to ask questions through this forum, they can always ask their questions through email, and always willing to assist. I don't know, by the way, Dr. Mohammed,
Yes.
who is the audience of this, of my lecture? Can you give me more information about that?
The audience actually, as I said earlier, is from different countries, especially from Gulf countries, Kuwait, of course, and other Gulf countries. And also we receive from other countries like from Asia, Africa, and even sometimes in Europe, from Europe. So it's like multinational and multilingual participants we receive. So Alhamdulillah, it has become like a global platform for Islamic banking and finance.
Alhamdulillah.
And in Arabic program, we normally receive participants more than 700, 800, 1,000.
That's nice.
Yes.
Inshallah, I'm here in Qatar for this is my third year, but then the pandemic popped in. You know, I need to learn the language, inshallah, but inshallah, let's see.
Inshallah, Doctor, no problem, inshallah. You are originally from?
I'm from Belgium. I was born in Belgium, but have Turkish roots.
Oh, I see. That's why I can realize some accent of Turkish language from.
Yes, yes. Even though I was born in Belgium, you know, it's like in the genes, I think. You don't lose it.
I see, mashallah. Just last week I was in Turkey.
Yes.
Just 2 days before I came back.
Mashallah.
So I think Mr. Saeed is there. He would like to say something. Mr. Saeed, welcome. I switch on microphone for you. Mr. Saeed Masoud, please welcome.
Excellent.
Assalamu alaikum.
Wa alaikum assalam wa rahmatullah.
Are you hear me?
Yes, yes, please.
Okay. My name is Jude Adidu from Malaysia, from International Islamic Malaysia, Kuliya of Islamic Banking Finance. I like to ask the question that our
Dr. Saeed,
I cannot hear him.
Your voice is not clear, actually.
If you can ask the question in the chat box, it will be more better.
Or you may write in chat box or question answers box, inshallah. Your voice is not clear, yeah.
Okay, because there's a rain here, that's why. Okay, I will write on chat box. Thank you.
Thank you, Mr. Saeed.
Okay, thank you. Anyone else? Please feel free to ask or to add any comment, any additional point to market discipline in Islamic banking, so we may learn more from you as well.
Dr. Mohammed, what I am more interested, let me tell you a bit more about my research. What most of the researchers do is a comparative analysis, you know, for instance, in terms of performance of Islamic banks compared with, you know, conventional banks, the stability. I am, from my own research is more about the customers of banks, how they behave. So it's more a behavioral perspective. I like to analyze, and because it makes it more fascinating how the customer of a bank behaves rather than looking at the resiliency, because there are much better experts in doing that. So I am more engaged with the behavioral perspectives of customers, and this might be even the borrowers. So for instance, how the Islamic borrowers behave compared with conventional borrowers, how the Islamic depositors behave. I like these kind of researchers studies much more. You know, it that is something that attracts my attention more than having a broader view of stability stories or whatever.
Inshallah. Thank you very much, Doctor. So your bachelor and master's from the same university or from?
Yeah, from Ghent.
From Ghent.
Belgium.
Okay. That means Islamic banking and finance also is there.
No, it's not. I started with Islamic banking after my PhD. I have a conventional background.
Oh, I see.
And I think it's a strength, to be honest.
Oh, mashallah. So it has a kind of transformation to Islamic finance and banking.
I still do research about conventional banking because it's very hard. We have this publication requirements, etc. Although it has diminished, I still have some ongoing projects, but I think it helps to have a broader background.
Yeah.
Not only Islamic finance background, but a broader background. I think
Yes.
I think it is helpful.
Yeah, definitely. If we don't have broader background, then how can we implement Sharia compliant modules or strategies?
Definitely.
So we still waiting for any more questions.
Yes.
Okay, Dr. Saeed already has written. My question is, what name is the best to give the Islamic insurance? Is takaful or cooperative insurance? As we know that takaful is Arabic name. I mean, he is asking either to keep it as takaful or like cooperative insurance.
Yeah.
Takaful is an Arabic term.
Yeah. Yes. I always have the opinion of what's in a name. I don't think it's very much important. Let me give you an example with banks. Even with Islamic banks in Turkey, they are called participating banks or participatory banks. In other contexts, they are called Islamic banks. I don't think that it is something that is very important, to be honest. If takaful is something that is standard, let's keep takaful. And by the way, what I really think is you also in terms of standardization, I believe that some of the components in whatever language it is, although the Arabic is more pressing, of course, with musharaka, but I think some kind of standardization is needed. It's, that even in academia, let me give you one example, brother, Dr. Mohammed. If you look at the English writing style of Sharia, right? You can write that, I think, in 5, 6, varieties. Sharia on itself, sometimes they write with a comma, sometimes they, I think it is very important to standardize these concepts as such that we all use the same concepts. Even with musharaka, some put an H at the end, some don't, some write like with double A's in English, the English versions. So I think standardization is very important throughout academia, by the way, because it is quite confusing, and especially for someone who is not being in touch with Islamic finance anyway, and he reads like, different versions of musharaka, for instance. It does not help us. And if takaful is, for me, the accepted norm, as for Islamic insurance, let's keep it.
Yes, Doctor, I agree too. I think because takaful has a deeper meaning, and it is already very well known to, the world and the people of banks and Islamic finance. So yeah, thank you very much, Doctor. Another question from Mr. Ibrahim Ahmed. What will be your advice for an Islamic finance enthusiast from Sharia background, but want to be more into financial aspect also? What roadmap should be followed to attain his or her goal? Should we go back to degree in finance or take courses or what? Yeah, Victor, if anybody would like to know more about Islamic finance and banking, what is your advice?
Yeah. You know, let me tell you a little bit my own experience, because I have a conventional background. The reason why I started with Islamic banking research was that even in the field, so this was more a personal, point. Even in Islamic banking research, who published the best articles? The non-Muslims. So I found this a bit strange, to be honest. They published in the better journals, whereas or Muslims were not able to do so. And that's why I started with Islamic banking as a personal challenge. It was like an intrinsic motivation. And alhamdulillah, we have done well, to be honest, because last year, it's not about bragging myself, but I'm just telling you, I'm just trying to give you some background information. I think, last year listed on the 5th place in Islamic banking impact research globally. What do I mean by this? So I started, I think, in 2016 with Islamic banking research, and having or being listed as the 5th in the global. So this tells a little bit about the impact of Islamic banking research. I am a rookie, but still I was able to reach that the 5th ranking. This tells actually much more about the in-depthness of Islamic banking research or Islamic finance research than my achievement. Let's be honest. And what I also, because I started teaching Islamic banking after I arrived here, I had some experience with teaching, but those were more like on a guest lecture level. But I started teaching Islamic banking when I came here to HBQ, because we have an Islamic finance division. What I found is that the Islamic banking textbooks are in general very shallow. So what do I mean by this? So for instance, this component, market discipline in Islamic banking, you will never read this. You will find this nowhere. Although it is a quite established in the conventional literature. So it is all about this is my own personal experience, that Islamic banking, it's all about promoting profit and loss sharing, the idealistic view that is always put on the textbooks without going into details. From this perspective, I really think that you need to start first the conventional literature as such that you become more, you approach the Islamic banking literature more critical. And you will be able to do that because you only need to read like 2 Islamic banking textbooks to assess that it really lacks in-depthness. And that's also a bit unfortunate, to be honest. And we are, I also blame myself in this, but we have these publications, it should be more contentful. But there are now, alhamdulillah, more and more attempts into that. Let me give you one example, Dr. Mohammed. So in economics, what is really established is microeconomics, the foundation of economics, right? We don't have that in Islamic finance. We don't know that in Islamic finance. And you know that, for instance, that graph that I showed you with the vertical axis, the I component of the conventional rate that is transformed to a profit ratio shared to the depositor, that we need such kind of approaches that that tries to make that tries to give a better understanding, a deep knowledge of it. But I know I haven't checked it yet, but I recently saw on LinkedIn that there is a professor in Turkey working on these microeconomic elements. So Isha, I'm very eager to look at that, to be honest, because we really lack thoroughness, in-depthness. That's the issue. And every attempt to fill in this gap would be very much appreciated, to be honest.
Inshallah. Thank you very much, Doctor, for this wonderful elaboration. And we thank you as well, Mr. Said. Next question from Sister Manal Osman. Yes, Sister Manal, welcome. Please. Yeah.
Assalamu alaikum. My name is Manal Osman, a PhD student in Germany. My question is, now the Basel III requires the conventional banks to have a minimum buffer, no, for capital buffer.
Yes.
And this is basically based on the risk-weighted averages, no, 2.5%,
Yes.
as I know. My question is, there some, does Basel III requires Islamic banks also to have something like that? And if yes, how is this implemented to the different modes of financing?
That's a very interesting question, Ms. Mara. By the way, in what is your research about?
Risk management. I'm doing some comparison study, risk management between Islamic banks and conventional banks.
Ah, that's very interesting, mashallah. That's a very good story. And as you know, to give the audience a bit more background information, what Sister Manal said was Basel III or any Basel requirements, right? In this regard. So you have to hold a portion of your risk-weighted assets as a capital. And she was referring to these capital buffers. And I believe you are right that the tier 1 has increased from 2 to 2.5%. Now, how do Islamic banks do that? And actually, this comes to the discussion that I shared with you with the slide, where I put Islamic bank deposit, between conventional deposit and equity, right? To be honest, in practice, Ms. Manal, Islamic deposits are treated as, in many countries, perhaps there are some exceptions, but in many countries are treated as part of, are considered as deposits. So meaning, how is the capital buffer? How is the capital buffer defined? It is defined based on the riskiness of the assets. Again, so what do I mean by this? That there is no merger between equity and investment accounts in this regard. So they are seen as a bit separated, and they are also treated separated with this deposit insurance things, etc. So they are not seen as equity if you were referring to that. And how is, by the way, how is the capital determined? It depends on the riskiness of the investments that the banks are doing. And as you know, Ms. Manal, it is mainly debt-based investments at the asset side, through the Murabaha agreement. Yeah. So in practice, there is not much difference.
Okay. And are Islamic banks required to follow the Basel III in all our countries, or?
No, it is like this. So the Basel III, every country is free to implement the Basel guidelines. Most of them apply Basel III, but not necessarily completely. So every country can have its own, refinements on that.
Yeah.
And normally, because it is about financial stability, normally, I'm not talking about exceptions, Ms. Mama. I'm not aware of that. You should be aware of that, to be honest. But normally, it is about financial stability, and Islamic banks also, since they are part of the financial system, they are also subject to the capital requirements.
Good. Okay. Thank you. Thank you very much for your answer.
Thank you. Please send an email, Ms. Mama. I'm interested in your research.
Yeah, I've just sent you an invite in LinkedIn.
Okay. Good.
All right. Thank you.
Okay, thank you, Dr. Mustafa. Jazakumullah khairan. And thanks to Sister Manal for the question. And is there any more question? Or okay, Doctor, that's really a wonderful session, mashallah, and we enjoyed the session as well. Hopefully in next session, inshallah, or in future, we are going to have more interactive session with you, inshallah.
Inshallah. By the way, Doctor, are there like topics about, the Sharia approaches, about the, the metaverse, about cryptocurrencies? I'm very much interested. Yes. But in English, not in Arabic, in the English one. If there is such things, inshallah, send me an email.
English. In fact, we had already 2 sessions. One is from our one doctor from Lebanon.
Okay.
And we had session with him, and also we had another session with Mr. Mugesh Shaukat as well. Yeah, inshallah, in next session, maybe we can choose another topic relevant to that cryptocurrency or any.
Inshallah, I'll be happy to join them, inshallah, because I am very much interested in that. And it is very also because I know your audience is more about, with Sharia scholars, etc. You have two approaches, by the way, Dr. Muhammad. That's my, that's my observation from, from outside. Either it is accepting, or it is either more, showing a more flexible approach by default saying yes, or by default saying no. From a Sharia. So, and then you have those two camps, and it's very interesting to, and probably the truth is always in the middle, right?
Yes, Doctor.
So
Do you know Dr. Anwar Misbah, who is STEM professor at the University of Lebanon?
no, I don't know him, but if you can drop his name on WhatsApp.
Yeah, sure. He has some researches as well on cryptocurrencies. Yeah. Inshallah, I will email you, or I will WhatsApp you his name.
Sure.
Thank you very much, Doctor, for your time and for your effort. And we like to thank you very much on behalf of our Islamic Economics Association of Kuwait University. And we are really honored to have you in our session and in our platform. Hopefully, we are going to have you more and more in upcoming sessions, inshallah. And we thank our participants from around the world for your participation and for joining us in this session. Hope to see you again soon, inshallah, in other sessions and lectures. And we thank you very much. May Allah bless you. And we thank our staff members of the association, especially our Dr. Al Ubaid, who is the Director General of this Nadil Iqtisad Islami. And see you again, inshallah. Dr. Mustafa, if you have any last words, anything.
Thank you very much. It was really a pleasure for me to stand in front of your audience and to give a lecture about an atypical topic. I also thank the audience for their interest in the topic and for their questions. Shukran.
Fun. Thank you very much. Inshallah, with that we conclude today's session here. See you again. Subhanakallahumma bihamdik. Ashhadu an la ilaha illa ant. Astaghfiruka wa atubu ilayk. Assalamu alaikum wa rahmatullahi wa barakatuh.